Good morning. We start our continuing our classes on approaches to equity analysis for the fundamental analysis final portion of the fundamental analysis portion. After which we will continue with the technical analysis portions. Now, in our approaches to equity analysis, this formula we use to calculate the total outstanding share to calculate the EPS or the earnings per share. But in practice, the analyst use the weighted average shares outstanding. What is the weighted average share outstanding? Say during the month of during the beginning of the year, about there were 10,000 shareholders. In the middle of the year, there might be 12,000 shares. At the end of the year, the company might have issued new shares, and there might be 14,000 shareholders. So the company, there may be more or less. So the weighted average is calculated on the basis of how many shareholders were there during the company. Like we use the weighted average in case of calculating the arithmetic mean. So analysis often they have formulations available, they have softwares available for these kinds of things, and they automatically get the data from things such as CMI, Pravis, and all that. There's also the talking of diluted EPS per share. And a diluted EPS includes operations, convertible securities, and share warrants for dividends and all that outstanding. Whereas in the original portion, it does in the EPS, normal EPS, it does not include this into consideration. Now, another type of earnings per share is adjusted EPS. Now, adjusted EPS, it removes all the non-core profits. That is, say it focuses on calculation of the profits from the business itself. Non-core profit, what does non-core profit means? Non-core profit here means say capital profits. What are capital profits? Capital profits are profits you make on sale of depreciated assets, depreciated items, such as say plants and equipments. They say they are valued at a certain item 10,000, they're selling them at say 15,000, you're making capital profit. These are not included. So only in the operation, only the amount that is obtained from operations, core operations and normalized basis are taken into account. Now, approaches to equity analysis: for every rupees 1 the stock earns, say investors are willing to pay rupees stock 5, because say the rate of return is 20%. If the same rupees 35 stock is expected to earn rupees 9, say next year, then the price equity ratio would be 3.89, or 35 divided by 9 is equal to 3.89. Now, if that is is expected to earn rupees 39. Now, if for every rupees 1 the stock earns, investors are currently say willing to pay. This is the stock market calculation. That is, say the dividend is given is rupees 1, and the amount the amount the secondary market is willing to pay is rupees 5. And what is the earnings per share? The earnings per share is the same stock as rupees 35 is earned to rupees 9 a share the next year. This is the first year now. First year it was 5 by 1, but then the next years it is same as 35 and expected to add the and the they expected to earn rupees 5, and then the next year we have the price equity ratio is 3.59, because 35 divided by 9 is the amount. Now, price to book ratio. What is the price? So here we have 35 is the expected amount, and rupees 9 is the amount that is the earnings for that year. That is, the stock price would be 35 and the return would be 9. So the price equity ratio has changed to 3.8 and 9. Now, what is the price to book ratio? The price to book ratio is the one of the fundamental analysis tools, which tells you how much equity investors are paying for $1 in the net asset. Now, it is usually located on the company's shareholders' equity. What is shareholders' equity? It is the amount available to the equity shareholders. Now, in meaning, we have price, the book ratio is the financial core financial ratio, and book amount the company's current market share to its book value. Now, book value means what is the current market value. The current market value is the 35, and the book value of the share is calculated the total assets of the company less the liabilities of the company, what is available to the equity shareholders divided by the number of the equity shares. So that is the we calculate the book value, and we divide the market value by the book value to obtain the price to book value ratio. How much you see how much there has been appreciation in the terms of the share prices. Now, dividend yield ratio. Fundamental analysis tool means refers to the financial ratio in which you know how much the company is paying out as dividend. Say the stock price of the company is rupees 5, and however the company is paying dividend. The face value of the share is rupees 5. The company is however paying dividends of rupees 2 each, on um, um, of rupees 2 each on mm, mm, on rupees 2 each on say uh, rupees to each, and this is the dividend payout ratio, but there is no limit on how much and how many times the company can pay that dividend. This ratio is an important in fundamental analysis. The dividend payout ratio is a financial how much the company pay dividend every year related to its share price. The ratio is represented as a percentage. Now we also have this whole portion. This is the basic fundamental analysis that you require for your fundamental analysis portion. Now, if we have any questions on this, then you may continue on the doubt clearing session. And this is the whole portion, the dividend yield ratio. This is the main thing, the earnings per share ratio, EPS. And this is, then we have the diluted EPS, then we have the adjusted EPS, and then we have the price to book ratio or the PB ratio, then we have the dividend yield ratio, then we have completed the fundamental analysis portion. This ends our discussion on fundamental analysis, and we'll continue with our new topic, technical analysis, in our next portion in the next class. Thank you.